welcome, Jeff Montgomery. How are you?
Thank you. Great.
Yeah.
Pleasure to be here.
And you're Vice President of Acquisitions with Core Pacific. How long have you been with them?
Going on 6 weeks.
All right.
Yeah.
All right.
No, it's been a fast-paced start with Core, and we're came in from institutional investing side and brought that side of the experience onto them, and we were able to lock something up real quick right before the storm hit. So
that's really good.
We're excited about that.
Yeah. So 6 weeks, you came from institutional. What was your previous life?
Yeah, my experience has been institutional investing for family office. They have family office funds. And
Single, multi-family?
All multifamily.
Okay.
Well, actually, I take that back. I started in the GFC, coming out of the GFC 2012 with single family investing, buying foreclosure deals out of the recession, and
that's fun.
Amassing portfolios on that side. So that was kind of the Wild West before the latest build for rent round really took off, and that was a lot of fun.
Very good.
Yeah.
And they hired you to be the head of acquisitions.
That's what they're telling me.
So
yeah.
a lot of time on the road, or what?
Yeah, a lot of time on the road. We came into this understanding that there's the fundamentals of the industry are very strong. We like the multifamily space. The company's in multifamily and industrial, has history in industrial, and then bringing me on to help grow the multifamily portfolio. So at one point, the company had as much as 10,000 units.
Wow.
We are down to around 3,600.
Oh, good doors.
So going full cycle on some of those deals, some of the legacy assets as well. So they brought me on to help grow the portfolio and work with the team and go find new markets and new opportunities.
Very good. Are there specific areas where you're looking at?
We are. So we have a lot of history on DST side with Sunbelt, Midwest. We are bringing that. We're continuing to search there and opening new markets as well. What we're primarily focused on when we're identifying a new market is we want to know that this is going to be a stable market, a good, solid investment for the next 10 years. So we're coming in with the investor's eye on targeting a market. We first go in and identify a group of areas that are potential, and then we dig in. So we're doing the work in advance of trying to find a deal. We're identifying a market, sniper approach to that, doing our diligence, boots on the ground. For example, in Denver, before we entered this market and said this is a market that we have belief in, we did all the research entering. I personally was down boots on the ground, driving neighborhoods, meeting with local brokers and investors, and asking the questions of where do we target? What's the right side of the street? What's the wrong side of the street? We want a real deep understanding of the market so that we can really sell this to ourselves and to ultimately the investors that we believe in this investment and this market.
Very good.
So that's where we're at now. We expanded into Denver. We're looking at other markets, including some of the Texas markets.
Okay.
Next on our list, we've been out in those markets, doing boots on the ground, driving the markets. I think in San Antonio, I put 400 miles on the rental car. So we're out in the market trying to get a real detailed understanding.
Are there any specific areas or markets that you're intentionally avoiding?
Overheated markets.
Okay.
We use data providers like Witten Advisors and CoStar.
You're concerned about red, blue states, migration?
That comes into play, but more so, we want to know that they're pro-business. So I believe Denver just went blue, but it's Denver is a good example of this. We liked the market because we understood that the leadership was focused on expanding the business, bringing new companies in. You had the whole Broomfield corridor where you saw tremendous growth over the past 5 years. We target markets like that. So it's not specifically a red-blue deal. It's how pro-business are you? Because that's ultimately our employment base.
Are you looking generally for markets that that'll mature, so you'll have an exit within that DST timeline, within 7 to 10 years, or do you have a longer horizon than that?
No, our horizon from the DST investor side, the underwritten business plan is 7 to 10 years. We're putting debt on it that is going to be stable throughout that hold period, also providing the optionality on the exit. Our takeout on a lot of these transactions we're buying core plus. The takeout's going to be family office, institutional value add players. So we do target the markets with an eye on the horizon and trying to read our crystal ball as best as we can, understanding that these are going to be good markets today and through our hold period, and are going to sell well ultimately to that next investor.
Tell us about Core Plus. You mentioned that in our pre-meeting a little bit.
So Core Plus, core asset, brand new, straight from the developer, primary markets. That's one aspect. The Core Plus is take a 2014, 2012, or even just a few years old, where there's institutional investors, it's a primary market, and there's new developments nearby. So you've got brand new development within the area that shows a path towards, hey, if we improve this slightly, we improve this slightly dated product, we improve that, we're going to see a lift to our NOI.
Okay.
And what Core Plus provides us the optionality of is we're not solely dependent on market movement. We're not just underwriting rent growth. We're underwriting rent growth, and we're looking for markets that have a solid rent growth. But the Core Plus gives us the optionality to look at a market that's not the highest rent growth, but is going to be a stable rent growth, while also giving us that NOI lift through a value add, through a improvement of the common area, ultimately making the tenants more desirable, or having the tenants desire the product more, and be willing to pay a slight increase on the rent for that.
How has that changed? I know we track a lot of the student housing and with other sponsors in the market, and gosh, back when I was in college, back in the Stone Age, it was cinder block walls and a chow line, and now they're like country clubs with climbing walls and all of that.
Yeah.
How has the amenities changed over just last decade?
Oh, the amenities, that's a fun game. So on new development, luckily we're not the developers. So we don't have to sit back at a blank canvas and say, okay, what are we going to do?
Yeah.
It's fun. We've done it, but it's not where we're at now. So it's an interesting trend to watch, the new developers and the creative side and the designers, what they're able to come up with. We'll implement those trends. So we can capture the trends on the multifamily residential side of, hey, what are tenants ultimately demanding?
I don't think 10 years ago you heard about many pickleball courts.
No.
Right?
But now we're looking at those.
Gotta have your pickleball.
Yeah.
All right. Tell me about full cycle programs. How do you have full cycle programs you've gone through?
On the DST side, we started in our first acquisition was 2016. So 10-year, we're coming up 2026 is our full cycle. None of those have gone full cycle yet. We have, we'll anticipate those coming soon. But what we are seeing on those assets, we're exceeding pro forma on every single one.
Okay.
Our investors are happy. We're meeting all the returns. We haven't had any hiccups really on that side, which is great.
Okay. So you do generally hold them close to the full 10-year, or do you anticipate 5 to 7?
No, we try and get out, get the full ownership of it. So 7-10 years.
Okay, that's good to know. And the investors did well. I think we were talking earlier about the kind of the 80-20 hitting the bonus potential.
Yeah. So this is a new aspect to.
And again, we're trying today to keep things as general as we can. We're not talking about a specific property or address or building, more conceptual. But I think that's something that's woven into a lot of your projects, right?
Yeah, we'll try not to get the compliance officers too excited.
Absolutely.
No, from a high-level aspect, one of the things we heard the DST investors, clients ultimately asking for was inflation. This was a couple months ago. It was inflation's going to happen. It's going to be an aspect. Sure. It's not a short-term transitory inflation deal. So what happens to our investment as inflation starts to increase? How do we hedge against any inflation impact to our equity and our investment? Our answer to that, and the markets asked for this, was we'd like to participate on additional cash flow over and above the threshold. So we worked with our attorneys and our compliance groups and everything, came up with this structure where we split over a certain threshold, we'll split 80% of the additional profit goes to our investors.
That's excellent.
Yeah.
Yeah, I know we've been, that's a question that's come up so much just with the last $6 trillion dumped into the economy. Not that there's anything wrong with that, of course,
Yeah.
but folks are asking, well, just, gee, what about inflation? I can see the yield and the numbers they talk about on the TV about inflation are higher than the yields we're talking about. Does that mean I'm going backwards?
Right.
And so we find we're having to, we're in a good position because we like to contrast projects that have a master lease, that have that pricing elasticity built into it, against a fixed lease, triple net that's going to be there for, maybe there are rent bumps of a couple % a year, but they're definitely not going to keep up with inflation.
Sure.
So I think you got a very competitive edge there.
Yeah, I mean, our goal at the end of the day, our pure focus is to the investors.
Yeah.
So we're buying these assets, we're putting our own money in it from the start.
Mm-hmm.
Our investors are coming in and taking us out. We want to be sure that we're structuring a deal that is attractive to that investment group and is going to be a safe investment, a good shelter of capital for that long-term hold period.
It strives to be a safe investment.
Right.
Yeah, okay.
Compliance.
The little guy right on my shoulder
Sure.
all the time, Has Core ever missed a distribution payment?
We've not.
Okay. How did you do during the lockdowns? How was all that?
Lockdowns on the multifamily side. So I mentioned I started in 2012. So I've seen some of these movements, and it's been an interesting roller coaster. So pandemic period for multifamily. Initially, it was scary going into it. Are we doing full recession, or what's going to happen from the lockdowns? Ultimately, multifamily proved to be extremely resilient going through this.
Is it agency debt that you have?
We do agency.
Okay.
Yeah. A lot of agency, some bank, but
Okay.
we're targeting agency on most.
Sure.
But multifamily was very resilient going through the slowing of the pandemic and the pandemic years. But then, given the properties that we selected coming out, we saw tremendous NOI growth from increased demand and kind of pent up demand on the tenant side as well.
Before you got there, with Core, have they been in a position to be opportunistic as other companies? You say the first deals they started doing was 2016, so most of the trouble had been soaked up by then.
Sure.
But is that part of their model?
So Core as a company has been around over 17 years. Right. They've gone through multiple cycles and through the GFC even, and through that, yes, have been able to find opportunistic opportunities, and given the long horizon of the company, long-term view of investments, there are legacy assets we still own that were acquired pre-GFC.
Okay.
So we were able to ride through the GFC recession, ride through the ups of that, and are still operating those and exceeding our expectations of what those would do.
Tell us a little bit about the leadership at Core. Who are the big dogs? Besides yourself. Yeah.
I don't consider myself that. We have our leadership team is really top notch. So Justin Moorhead is our CEO. He's taken the lead of running the company. Younger professional, very anxious to grow the portfolio. As mentioned, we originally had at one point had over 10,000 units. We're looking to bring it back to that. So the directive is coming from Justin to say, hey, we want to take this company. We believe we have all the resource and everything for this company to grow. We're going to make sure that we do that in a smart way. So from a leadership standpoint, that's where the direction's coming from the top down, and we're taking it and running with it.
Excellent. Let's see. It's kind of a total softball question, but within the, Core is one of the top selling DST sponsors, right? Within your offerings, what are some of the key differences? You mentioned the bonus, 13th distribution true up kind of thing. That's pretty cool.
Yeah, so that's a black and white difference between us, or differentiator between us and our competitors on the market. And again, that stemmed from we're listening to the market, we're listening to our investors, and we're asking them, hey, what do you need? We're in constant contact with our deployment base, our equity fundraisers and our investment advisors are talking to the market and feeling it out daily. So that's one aspect that sets us apart. What really sets us apart is we are a younger growing company. From the DST side, we're focused on, we want to buy the right deals. We're doing this practice approach from the submarket side, making sure that we're taking a sniper shot versus a shotgun, where you look at some of the larger investors, larger investment companies that are out on the DST, they need volume. So they're pushing for more volume, pushing for more deals. We like volume too, but we're taking a more practiced approach to that and making sure we're buying the right assets. So we're making sure that we're buying blue chip properties and taking that real detailed approach where I personally am seeing every asset before we're even bidding on them. So our investment committee is reviewing the deals in step with the acquisitions team. So we're making sure that we're doing true almost pre-due diligence before we even
Let's talk through that a little bit. How do you guys underwrite a property?
Sure. So we started the market. Mentioned a couple times, if we've identified this is a market that we really want to enter. It's more advantageous for us from a management side. So stepping back, we're a vertically integrated company. Property management, investor relations, accounting, everybody is in-house. We don't sub out property or asset management. So we're in lockstep with both of those teams in reviewing the market from the start. But once we've identified a property that we'd like to target, usually through either off-market or through broker channels, we will fly out there and go check out the property. We'll initially do a desktop underwriting, including rent roll analysis, T12, do market research on pipeline. Is there a large development pipeline? Aspects of the property that are going to impact the long-term ownership. Ultimately, designing a business plan for the property. And this is all happening before we've ever bid on it. We will come up with a business plan. It's going to be a core investment. What are the attributes there? Core plus, what attributes are there? Are we buying this from a merchant build where operations have been up and down, going through lease up? How can we utilize our in-house property management to come in and optimize income, expenses?
Is the in-house property management, is that just the management of it, or do you have your own improvement teams, your own?
It's property management and asset management all in-house. So starting at head of asset management and head of property management, filtering all the way down to the on-site staff. So we have regionals throughout the country who manage multiple assets, and then boiling up to our head of property management, sits in an office a couple doors away from me.
Okay, very good. Let's see. Interest rates. I mean, that's certainly been a hot button.
Is that a topic, huh?
Let's talk about that. I mean, we're turned on the TV the other day. They said inflation's done.
It's done.
And then was talking to Art Laffer a couple of months ago at an event. Got a couple of minutes with him, and he said that we've never brought inflation under control in the country without raising interest rates at least 1 point higher than the rate of inflation. And at the time, inflation was somewhere between 8 and 10, depending upon if you included those pesky things that keep going up or not.
Sure.
Right. So, how are you guys positioned then with inflation, with interest rates?
Sure. On existing assets, we're placing fixed debt. So we have been fixing interest rates for the hold of the asset. So. Existing assets, we're good there. From an acquisitions point of view, it's probably echoed throughout the industry. It's frustrating because you're looking at a market that has good employment, good fundamentals. The property fundamentals are great. The market fundamentals are great in all of our markets. But you're looking at a capital environment where you run into interest rates being quoted at higher rates than what cap rates are at. So how do you make that work? We are getting creative on the acquisition side of looking at doing interest rate swaps, potential caps, or one of the things that we've started to chase heavily that I don't know if it's a secret as much anymore, but was looking for debt assumption. So early on, we had pivoted to start targeting, hey, is there a group that's already placed debt, would like an exit?
Much of it?
we have on a few markets, very
Wow.
market specific.
Yeah, don't tell anybody.
Yeah.
Yeah.
Can't tell you which
right.
which opportunities you've been chasing right now, but no, we've been in discussion with some off-market groups and off-market properties to try and acquire one that has much lower interest rate than what you can get on the market today.
Sure. All right. Let's see. Well, one of the terms you threw out earlier was big scary patches of dirt. I thought that was fun in the neighborhood. So really knowing, do you get in with the planning commissions? I mean, with the spend much time with them, with the local counties? What's going to happen over the next 5 or 10 years?
Yeah. So earlier on in my career, you had to go to the planning commission and call a lot. Thankfully, a lot of the data sources have now started taking that role of making the phone calls and building the pipeline. But there still is an aspect to that where once we get further along in a diligence, we'll call and verify, who's building what and where. From that comment, scary patches of dirt. When you look at satellite views of real estate, and we start off looking at the satellite view of Google Earth and saying, hey, what's that big chunk of dirt over there? What are the entitlements? And you can a lot of this research online. What's it entitled for? Is somebody very close or could be very close to starting a project? And it's not a deal killer. It's we need to understand this. We need to underwrite this in the business plan. Understanding if there is going to be a new project popping up nearby, what year is that going to deliver? How much type of concessionary environment could possibly exist for a short period of time, and what's our game plan to be able to ride that? We want to make sure that we understand all that, so there's no surprises throughout the ownership.
Okay. Here's some basics basics in the industry. Describe what is a cap rate.
Oh no. So cap rate, NOI, net operating income divided by your purchase price. So easiest metric, or one of the easier metrics in the industry. A lot more detailed metrics go into our analysis, but cap rate's a good, initial barometer of where deals are, and it's also a way that we're valuing property, so it works both ways. So when we're looking at a property, we're looking at what's the current income, in-place income, what are expenses, what changes can we make to that, when taxes reassess, what's the impact of that, ultimately down to a net income before debt, and dividing that by the purchase price gives us a good point of reference from other assets.
Where are they now in multifamily properties? Is there a band you're looking for, or is it regional?
Who are you asking? No, there's a difference there's a chasm right now between buyer and seller. So the buyers are coming from the sellers are coming from a market where they were selling a deal 6 months ago that's a 3.5 cap market.
Which is crazy.
Yeah. But interest rates were in the twos. You now have a market where interest rates are pushing 4, 5, 6, and you've got a seller or you have a seller who's going from that 3.5 to now, hey, I'm giving you 100 basis points increase, I'm at 4.5. The problem is, and what's creating the divide right now is the buyer is looking at a 6% interest rate, high fives interest rate, and saying, well, that's too much negative leverage. I really need to be pushing closer to a 5. So that's why you've seen a lot of the transaction activity of late really just take a pause. So a lot of our competitors, especially institutions right now, are sitting on the sidelines. They have buckets of money. They need to deploy it, but there's this chasm between buyer and seller of where they view the cap rate value of their property.
Can you make up for it with the Core Plus?
We can. So that's why that's one of the aspects of looking at a Core Plus deal is we'll start out with potentially a little bit of negative leverage, but throughout the first year, through executing the business plan and not relying on rent growth, relying on just natural growth through the business plan, we're able to make up for that negative leverage.
Here's another basics question. Describe when you would have a master lease. What's a master lease, and why do you have it in a DST structure?
So I mentioned my history wasn't on the DST side, so I'm learning along with everybody else. But my rudimentary understanding or layman's understanding of what a master lease can be explained similar to a ground lease.
Okay.
In that ground lease, you have a property owner, you have a landowner. When you're buying the property, you're buying the asset, not the land. Similar to that, the master lease is the DST investor owns the asset. So they own 100% of the asset. What the MT, the master lease, is paying a lease on is the operating of the asset.
Okay.
So we're the DST owns it, the DST investor owns it. Us as a sponsor are managing income through expenses, through all the financial side of the deal to a net number, and then we're returning back to the DST investor a lease or a payment for giving us
that makes it
opportunity.
real clean for the DST sponsor and for the investor to be able to have one. They're getting one payment. I think it's also part of the DST requirements themselves is you can't change leases. You got to have a lease on that property. So what do you do when you've got storage units or apartments or college kids moving in and out, right? So that way you've got one master lease who's taking care of all of that in and out stuff, but it satisfies that DST. One of the things I like about the master lease is that pricing elasticity. When somebody moves out, I mean, you see the rents can go up, 5-10% in the multifamily.
Right. Yeah. So from the property management operating side of the asset, this is an advantage of multifamily.
Absolutely.
You're not locked in for a 5-year lease. Our typical lease averages from 10 months to 12 months to 14 months, kind of depending on the market. But a good average is 11, 12 months. And you're able to reset based off that. So whether the tenant moves out, you have a new lease coming in, it resets to the current market. Excuse me. It'll reset to the current market. If you have a renewal, you don't always get to the top of the market, but you get a lot closer to that. So by having the property management side, the asset side leases constantly turning, you don't end up with a large loss to lease or a large discount to where the market is.
And so most of them are 10, 12, 14 months in that range?
Excuse me. Yeah, so our typical lease at multifamily is 11, 12 months.
Okay, typical 1 year sort of thing.
We'll lease anywhere down from 6 months to 12 or 14 months. Difference being we'll price different premiums based off that. And another aspect of having this flexible lease is we will schedule leases based off seasonality. So Denver is a seasonal market.
Sure.
Winter is not the time you want to be doing most of your leases. We'll anticipate that when we're signing spring leases. We might shorten them up a little bit so that they expire in summer. Or we may push a later lease in the year to expire later so that we're not hitting that winter window. So that.
Now, do you guys use that, that latest software that my daughter went out and got an apartment, and it was her first apartment after she got out of college. And she checked, it was with in the Denver Tech Center area. And so she looked at what the price was, and we were talking about it, and she checked back 4 hours later, and the price had changed. And the next morning, the price had changed. It was just the flexibility of that. I think it must be the software systems that are constantly changing that.
So rent optimizers, LRO and YieldStar, I believe, are the two main players in that today. That's really taken off. You used to have, years ago, the on-site staff would set the rents. They'd call around to the market. They'd say, hey, what are you leasing for? And we'd play the game and try and set where the rent should be on every single lease. It's inefficient. Also allows human error and all that kind of stuff. So what the lease optimizers do is put an algorithm together where they say, I know based off the competitors who are also using this system, anonymously baking that in there and saying, hey, market rent should be around this. You have vacancy at 10% in your 2 bedrooms. So that's a higher vacancy. So we need to lower the rent a little bit to entice some more volume there. Your 1 bedroom is full. You have one unit available. We can try and get a higher rent on that. So that this is going into an algorithmic program that Initially sounds like, does this really work?
I think
But
it's similar to the way the airlines price their seats and the way I think it got really strong with the storage units.
right,
They were doing a lot of that as well.
yeah,
That's interesting. Multifamily with the DSTs had, well, until just a few months ago, it was kind of lagging as far as the yield is concerned. There wasn't much to drive it on the upside. But
Sure.
I think with the inflation and with the what we've been talking about here, the elasticity of that really does make it one of the better inflation hedges.
So, kind of what we were discussing with the being able to schedule leases and reset leases as they turn over on an individual side, unlike an office tenant, unlike an industrial tenant, where it's a longer term lease with certain steps. We're able to ride with that inflation, and that goes back to what the investors were asking for on doing a bonus rent profit share program. Was they were wanting to know that multifamily is a hedge against inflation. The reason for the hedge is because of the shorter term leases and the more turnover. Let's participate in that, and so. Yes, on the multifamily side, from trying to hedge inflation and preserve capital, it's a better avenue than some of the other asset classes, especially going into the environment where it might be a little bit cooler for the next year or two.
Okay. I'd like to dive in a little bit to some of your background there. It's interesting with the family office background. Is that, when I think of family offices, I think of a lot of wealthier people.
Sure.
Who, single family or even multifamily offices. And a lot of those people had to work really hard to inherit their money. So they're very, protective of it. But they're not trying to shoot the moon. They're not trying to that's something I hear from layman walks in off the street. They feel like they wish they could invest like the big guys, because surely those rich guys they're making 20-30% on their money, right?
Right.
I think it's more of a reality that they want to, they don't want to lose it. They want to get a good return. They want to keep ahead of inflation. What kind of lessons do you bring from the family office, perspective?
And it's the name of the game of the DST almost is wealth preservation and growth, stable growth. From the family office side, you're right. They either started in a different avenue, were able to build a mass of wealth, or started in real estate, a lot of them, and through time, were able to grow their portfolio. So a great way of doing that is through refinances and ultimately long-term ownership. So the guys who are really making wealth are long-term owners. The guys who are, might get a good year, might have some bad years, are the ones shooting for the moon. So when you're looking for the stable investment and the stable investors, which family office does, you are looking for that longer-term investment period, or even shops that I was at before. It was a shorter term; it was more 5 years, but it was done under an umbrella structure where the investment turns over. So we're building a fund that will deploy. The property may be owned for 5 years, but its business plan will be shorter. It gets recapitalized, refunded into the fund, and continues. So, name of the game on the wealth preservation side really is the longer-term investment period.
Okay. Would you say that's the main difference between family office and retail investors, retail clients?
Family office and the retail DST side, I guess it depends on which perspective. From the perspective of the company acquisitions, family office is a simple LP, limited partnership, GP, general partnership type structure where your LP partner will be an outside investor potentially, or even inside investors, and they'll be 70% of the equity on a certain deal, or more or less. The partnership, the sponsor in this case, GP in that case, operates the company, makes the decisions day to day, executes the business plan, and pays a percentage share of the revenue that comes off of that to an LP investor. On putting in the perspective of DST, the DST acts like that LP investor, where it's limited partner, it's kind of hands-off investment where they're not having to deal with the day-to-day and the day-to-day dramas of leasing multifamily and turnover and things like that. So Us as the sponsor will handle that for them.
Okay. So even though they're a family office, they still enjoy the DST structure.
Similar, yeah.
Yeah. Okay.
Yeah.
Is Core involved much with doing custom deals? Would a wealthy family come to Core and say, "Go find me something," or what have you seen out there?
No, our current focus is 100% on the DST raises
Retail
right
DST
now.
side.
Retail DST side.
Okay.
Yeah, we could go that direction in the future, but currently focused DST.
Okay. Who are the biggest lenders, or the best lenders right now in the space?
We mentioned Fannie Freddie agency. They're still active in the space right now. Banks been active. Life cos, there's whispers. Life companies, there's whisper that they'll be coming back in.
Okay.
Q1 next year.
Okay. And are the terms right now stable, or are they very much in flux?
They're in flux. We saw the 10-year go from, I believe, 4% into the 4s last week to this week. I looked today, we're at 3.77. So that, the Treasury's moving around. Spreads have been relatively stable, 150 to 170 basis point spread on that. But what's hard on the acquisition side right now with that instability from the Treasury side is pegging. I'm going to close this deal. I'm going to lock this deal up today. I'm going to close it in 60 days. Where's my interest rate going to be? Where's my interest rate going to be when I lock it? So that's actually what's keeping a lot of the institutional investors on the sidelines right now is, there's too much turmoil in the market. We're just going to wait. So a lot of those groups have waited. And our most recent acquisition, that was the case where it was the first time that interest rates started moving around. Institutions went to the sideline. We were able to capitalize on that and find a really good asset and not have to compete with a lot of the Blackstones of the world and larger institutions.
Yeah. The how's your LTV changing? Are you guys trying to have less debt in deals now, or you consider doing any all cash deals, or do you?
Back on, we're doing what the market's asking for. So we have the flexibility as a company to go both ways. Lately, the DST market has been asking for higher LTVs, so we're trying to target deals that have a higher LTV. Okay. As needed, if the DST needed to go the other direction, we could go lower LTV. So it's just more market driven.
Very good. Let's see. Talk about you a little bit. You said you're from Orange County?
Yeah. Born and raised California. This white stuff out here in Denver is a little scary, but
they've been known to ski in California a little bit. Did you ever get up to the mountains?
We do. I snowboard in the winter. You're
supposed to snowboard in the morning and surf at night, something like that.
That's the deal. Surf in the morning, snowboard in the afternoon. Yeah.
Where'd you go to school?
UC Santa Barbara.
Gee, that's rough.
Yeah. It was hard. I used to say that my dorm room was, fourth story on the edge of a cliff overlooking the ocean. I go, well, yeah, you better not get used to this because it could be a while until you can replicate it.
Some of my family members went to Pepperdine, and they were
that's great.
Fond of that as well. So, yeah. Were you into sports at all, or what did you like to do in school?
In school, it was more getting in, getting out, and getting to work. Sports growing up, did the typical football, baseball, things like that. So.
Yeah, you look like a middle infielder,
Picking the daisies in the backyard, right?
Absolutely, something like that. Well, this has been good, and I know we really like working with Core. I love the direction. You've got 2 or 3 real solid, I think, leverageable points of difference with your approach to multifamily and being responsive to the market. So best of luck to that, and
thank you.
Hope to see you back out in Denver again sometime soon.
We will be. We've got the beachhead here and ready to go.
Very good.
Pleasure.
Thanks, Jeff.
Thank you.
Impact 1031 is a DBA of Ridgeway Financial LLC. Not an offer to buy nor a solicitation to sell securities. All investing involves risk. Past performance is not indicative of future results. Speak to your finance and/or tax professional prior to invest. Securities offered through Emerson Equity LLC. Member FINRA SIPC. Only available in states where Emerson Equity LLC is registered. Emerson Equity LLC is not affiliated with any other entities identified in this communication. Investment advisory services offered through AE Wealth Management. Emerson Equity, Ridgeway Financial, and AE Wealth Management are not affiliated entities.